You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started with industry happenings.
It's time to get a handle on the latest developments from the world of options. It's time for Industry Happenings.
In today's industry happenings, we want to be sure you've heard about a recent significant options industry announcement. NASDAQ has agreed to acquire the International Security Exchange, or ISE. The ISE is the operator of 3 electronic options exchanges and was the very first electronic options exchange founded in 2000. NASDAQ is acquiring the ISE from Deutsche Börse Group, who purchased it in 2007. On average, the ISE exchanges trade a little over 15% of daily U.S. options trading volume. The purchase price is $1.1 billion. Pending regulatory approvals, the deal is currently expected to close in the second half of 2016. Also in industry happenings today, we want to cover one of our listener questions. The listener asked, Joe, how does premium work when selling options? Does the capital hit my account right away, or do I have to wait until expiration? Well, thanks for the question. The capital taken in from the trade does hit your account right away. And then the listener goes on to ask, how does all this impact the margin or buying power of my account? Can I sell an option, collect the premium, and then use that as collateral to fund an additional trade? Well, there are a lot of moving parts in that follow-up part of the question. The answer really is dependent on the type of trade established. For example, if we have a covered call or cash-secured put, there is long stock or cash in the account to offset the risk of the option position. So once the trade settles, the credit taken in can be used for other opportunities. If, on the other hand, a trade created risk without the proper collateral in the account, say a sell to open order, the combination of the value of the option and any associated risk would determine if the credit could be used for other purposes. Positions of this type can command additional capital if the position value increases. And along those lines, one resource my colleague Bill Ryan suggested was the Chicago Board of Options Exchange Margin Manual, found on the CBOE website at cboe.com. That's the Margin Manual at cboe.com. As always, thanks for the question. Keep them coming. And thanks for joining us today on Industry Happenings.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Joining us today on Strategy Spotlight is Dan Passarelli, longtime CBOE and CBOT floor trader and founder of Market Taker Mentoring. Dan, thanks so much for joining us today.
Joe, I'm glad to be here. Thank you very much for having me.
Let's see, before we get into our conversation about the Greeks, tell our listeners, about your background and how you landed up with Market Taker Mentoring.
Sure. Well, I started out, early in my career, I started out down on the trading floor, trying to carve out my future, I guess, and started as a clerk, worked my way up to being a floor trader, and traded as what they call a market maker on the floor of the CBOE. I was a market maker for a long time in the Ford Motor Company pit. And then in 2005, the CBOE asked me to come and teach classes for them, and kind of found that was my calling, my way of giving back to the trading community. And I really like working with individual traders and investors and helping them become more successful. And in a roundabout sort of way, that's what prompted me to start Market Taker.
Dynamite. And I know you got a crew there with you at Market Taker, which is great. And in addition to your mentoring business, I know you've written 3 books. I'm not sure it's the most recent, but I know, the one I was going to focus on a little bit today, since the focus is Greeks, is Trading Option Greeks, how time, volatility, and other pricing factors drive profits. What motivated you to get into the book business? Not that it's a business, but what motivated you to write this book and the 2 others?
It's kind of a funny story. For those of you who aren't familiar with the Greeks, the Greeks are basically, they tell you everything you need to know about, how and whether and likelihood of how your position makes money or loses money. It's like the dashboard on your car, So when I first started teaching options for the Chicago Board Options Exchange back in 2005, I was teaching a really basic level class, like introductory to options. Here's what a call is. Here's what a put is. And I found myself talking to these people who were brand new to options, about a half hour into the class, talking about gamma and all these Greeks. Yeah. And I found that people were looking at me like I had 3 heads, And so I was
they took French and German in high school.
Yeah, exactly right. So, so I was kind of thinking like, wow, so, these, like, nobody knows these, like, extremely important things. And then as I began working with more and more option traders, I found that people look at the Greeks as if they're this, oh, that's for the really advanced people. That's only for professionals, and nobody really understood it. I'm like, how can you possibly trade without this information? Like, this tells you everything you need to know. And so that was kind of my motivation. Like, there's not really a book written only on the Greeks out there. There's not any really great information. So that was sort of my impetus.
Outstanding. And as you say, the dashboard, the Greeks are such a critical component if you're in the option space, and they just aren't that complicated. But I'm going to let you, speak to more of that. The theme this month at OIC in terms of all our different educational outreach is the Greeks. So why don't we get into exactly how many Greeks there are? Why don't we start with that?
Sure. It kind of depends on who you ask. I would say there are 3 extremely important Greeks.
That was my next question. How many are important? All right, perfect.
Yeah, right. Yeah, 2 birds with 1 stone, huh? I think the 3 most important Greeks are delta, theta, and Vega, probably in that order, but they're all important, so don't think you can skimp on Vega. There are a couple others that we might call second-order Greeks, Gamma, and then we could get into some really sort of far out there ones that a typical retail trader doesn't use, like Vanna and Voma and Charm and all that, but those are definitely a lot less common. I think if you focus on Delta, Theta, and Vega, I think you're all set.
Dynamite. Why don't we start by talking about Delta? How do you like to explain Delta?
Yeah, well, in my book, Trading Option Greeks, I give 4 definitions, but let's kind of stick with the basics. Let's stick with the most important one and the truest one. Delta is how much your option value changes as the underlying stock price changes. So, the easiest way to conceptualize that is everybody knows anything about options knows, hey, if I think a stock's going up, I can buy a call because if the stock goes up, the call price goes up. Great.
Sometimes.
Yeah, sometimes, right. And then that'll be key to our discussion once we get to Vega, of course. But, the question is, well, if the stock goes up $2, how much does my call price go up? Because maybe it's not really worth making this call trade. Like maybe I'd be better off buying the stock. I mean, if stock goes up $2 and my call only goes up 5 cents, well then, that's not really great leverage. That's not really a great thing. So it's really essential to have that information.
And are there different calls you can buy? So if the stock goes up $2, there's a better chance that the call will appreciate one versus another?
Right, and that's kind of the key, and that's one of the real practical uses of Delta. As you know, there's an option chain, they refer to it as. So on any given stock that has options listed on it, there are many, many different calls and puts. So one of the questions that any investor might have is, well, if I think the stock's going up and I want to buy a call, which of these many, many calls do I buy? Well, Delta helps you answer one of the questions that you need to answer to make that decision. Different options on the same stock will have different deltas, so that implies that they have different leverage, they have different risk, they have different reward potential.
How about give me an example with a $50 stock?
Sure. So imagine there's a stock trading at $50, and you think it's going to go up, so you want to buy a call. Nice simple example. So I could buy an at-the-money call, so that's where the strike's the same price as the stock price. And that typically has right around about a 50 delta as a rule of thumb. So that means the stock goes up by $1, the call price goes up by about half that, by 50 cents. Now, there's kind of something really special about that if you think a little bit more deeply than just sort of that surface statement. It's a measure of both sort of leverage and protection. So what I mean by that is, yeah, I could buy 100 shares of $50 stock. It's $5,000. I've got $5,000 at risk. Stock goes up by $1. I make, what is that, 0.2% or something. But if instead I buy this call on this $50 stock and maybe I pay $1 for it, well, I'm only risking $100. But I make 50% of what I would make if I spent $5,000. So, I mean, I could buy 2 calls and risk $200, and I actually make the same amount if the stock goes up, and of course lose the same amount if the stock goes down. So if you think about it, doing that, I have kind of the same leverage, if you will, if you want to use that word, as I do if I would have bought 100 shares, but I'm so much more protected because I'm only putting $200 at risk in this, hypothetical example here. And then to follow up where I think you wanted me to go, Joe, I mean, I could buy an out-of-the-money call that has a smaller delta, maybe a 25 delta.
Okay.
Or maybe an in-the-money call that has a bigger delta, maybe a 90 delta. And so that means, that out-of-the-money call, the 25 delta, it's not quite as sensitive. Of course, the price will be a lot cheaper for that option, the option premium that I pay, my capital at risk. So, typically traders are inclined to buy somewhat more of those and kind of get themselves back up to giving themselves some leverage. And then the in-the-money option, I can probably get away with just buying one of those calls because they move a great deal more in step with the underlying asset.
Good explanation. Does it work the same way for puts?
Yeah. I mean, just think of puts as, the same thing, but upside down or backwards.
Okay.
Puts also have deltas. Most of your brokerage platforms will display put deltas with a negative sign in front of them. And I think that's a pretty good way to look at it. What that implies is, hey, here if the stock goes up and I have a 50 delta put, well, that means I lose 50% of what the stock price moves. But if the stock goes down, then I make 50% of what the stock price, what the stock price lost, if you will. Of course, there's an inverse relationship there, puts versus the stock price.
Sure. Okay. Let's move to theta. Talk to me about theta.
Yeah, so theta is an extremely important Greek, and it's one of those that you give yourself enough time and you're going to figure out that there's a need for, understanding theta, even if nobody tells you you need to.
Yeah, that's right. Just look at your account if you're long options and nothing happens.
Right. So as we all know, as time passes, options lose value, all else held constant. Now, that's that in and of itself is kind of a interesting statement that we can talk about, actually probably for a long, long time, but let's be somewhat brief. I just got done saying, well, hey, if the stock price goes up, well, call prices go up. Yes, that's one factor of three important influences that affect the value of an option. Now, if the stock price doesn't go up, if it stays exactly the same, as time passes, the option will lose its value. It's called time decay. And that's measured by theta. Theta can be thought of as how much value the option loses as each one day passes. And it's measured down to the fraction of a penny by theta. Now, we can kind of combine, and we have to combine when we're analyzing option positions, the analysis of both theta and delta. Because, and this sort of alludes to what you said before, Joe, I said, hey, everybody knows if you think a stock's going up, you can buy a call because call prices go up as stock prices go up. And, you kind of joked, well, not always. Well, here's one reason why maybe that isn't always the case. If I buy a call and the stock goes up, I profit based on whatever the delta is, whatever the delta of my call is. I actually do make that money. However, if it takes a month for the stock to go up X number of dollars a share, I have a different factor affecting the value of my options. Theta, time passing. And so I might have one thing, delta, making me money, but yet another thing, theta, losing me money. So I've always kind of got to balance these two against each other, and then of course we'll throw Vega into the mix and really make things, a much more realistic model.
Why don't we do that? Roll right into that whole idea of Vega and theta and go for it.
Sure. So I encourage everybody, if these are brand new concepts to you, get on delta and theta today. Spend some time online or something, get to know your friends delta and theta. Vega is the next one, and you do have to understand Vega, but I'll give it to you straight. It is a little bit more complicated than delta and theta. There is a third value that affects the value of your options, and that's what's called implied volatility. Now, don't get too hung up on the word volatility. The concept and the valuation influence that we call implied volatility is somewhat rooted in the actual volatility of the underlying instrument, the underlying stock. But don't get too hung up on that. What implied volatility really is sort of a measure of the influence of good old-fashioned supply and demand on an option value. When Goldman Sachs comes in and whoever, some hedge fund or some very, very large investor comes into the market and buys up 10,000 calls or puts or whatever, he's creating demand. And just like anything else, any other physical commodity or service or what have you, everything's dictated by the laws of supply and demand. Somebody comes in and buys a lot of something, the price goes higher. Somebody comes in and sells a lot of something, the price goes lower. This affects options values as well, and that's measured by implied volatility. Implied volatility is how we measure that phenomenon. Now, it's a little bit esoteric, and it's a little bit, it's a little bit hard to see, well, okay, how does that really affect the value of my option prices? Vega is how implied volatility affects the value of your option prices. If a big firm comes in and buys 10,000 calls, well, what happens mechanically is that the liquidity providers, market makers, they say, okay, hey, I've sold as many as I can at this price, at this volatility level, so I'm going to raise my implied volatility assumption to basically raise my bids and offers so that if somebody wants to buy more, I'm not just unloading thousands of options at a single price. I'm ratcheting up my price so that I can, I can compensate myself fairly, basically.
That makes sense.
Yeah. And so they raise their implied volatility, and what that does is that raises the value of option prices. So it's simply a measure of supply and demand, and you see that all the time, like around earnings, for example. That's an extreme example. I give people all the time saying, hey, I don't understand what's going on. Every time earnings comes around, I want to buy a straddle to trade it, but the options are so darn expensive right before earnings, and then they're really cheap afterwards. Help me out. What's going on here? Well, what's going on is you're not the first person to come up with that idea.
Buy the rumor, sell the news, huh?
Yeah, exactly, right. So, so everybody and their brother wants to buy options going into earnings, whether to buy straddles as a spec or to buy calls or puts as a spec or to buy puts as a hedge. And so that drives the price of options higher, and that's implied volatility, and that is measured by Vega.
And is there a way for investors to track where implied volatilities have been over a period of time?
Yeah, so this is one of the things that all options traders and investors should do when you set up your options chain with your online broker. Almost all of them invariably will have different columns that you can set up, the bid and the offer and delta theta vega, and some people like to look at volume. Implied volatility should be one of those columns. So then you have it right there in front of you on every trade, and any options-friendly online broker will also enable you to use what's called a volatility chart. So a volatility chart is a lot like a stock chart that many of you, I'm sure, are familiar with using, that says, hey, today the price of the stock is here. Here's the range on my, candlesticks or open, high, low, close bars. Here's what it was yesterday, blah, blah, blah. You can do the same thing with volatility. Now, that's extremely useful because it tells you, hey, today options are at a volatility of, say, 30, but last week they were at a volatility of 20. What does that mean? Well, it means options in that particular instrument are more expensive than they were a week ago. So it gives you some good sort of relative information that helps you make better decisions as to whether it's a good time to be buying options or maybe it's a better time to be selling options.
So you're a believer in those volatility charts?
I am a huge believer in those volatility charts. I look at them on every single trade that I make because for me, I believe that that's the best way that any average investor, anybody who's listening to this right now, you can have an edge, and an edge over, in my observation, many traders out there, because there's a lot of traders who don't look at this. You can have an edge because you can know, hey, options are really, really expensive right now. I don't think I want to buy them. I want to rather sell them, or vice versa. Hey, options are really cheap right now. It's not a good time to be selling them, to be doing my covered calls. Instead, maybe there's an option buying strategy. So it helps guide your strategy selection, and it helps make you a better trader, I think, because it gives you sort of that edge.
Good advice. And for our listeners, you can also find those volatility charts on our website at optionseducation.org. It's in the drop-down column under Tools and Resources. They're the implied and historic volatility charts. So, Dan, I think great information here. Maybe we'll touch on one more thing, and I think I'll open this can of worms. Volatility as it relates to different strategies, the Greeks as they relate to certain strategies. Is there anything you want to say about either a bullish, bearish, or neutral strategy as it relates to the Greeks, or anything else?
Yeah.
That's a can of worms.
Yeah, it is a can of worms, isn't it? Let me just kind of come up with a sort of an example of where the Greeks really come into play, sort of off the top of my head, if you will. So let's say I'm bearish on some particular stock. All right. So as we've already established during our conversation here, yeah, I could buy a put because puts make money when the stock goes down. However, when I'm using the Greeks, I know that if I wait, say, a month or a couple of weeks for that move to happen, well, I can lose based on implied volatility, based on time passing, based on theta. And then, of course, I can work implied volatility into the equation here, but let's kind of keep it somewhat simple. So when I'm in that situation, if I'm looking for a move that, might not happen today, it might take a couple or a few weeks, I need to use the Greeks and use this information that I have of the Greeks to construct a better strategy that meets this particular market situation. So, one such strategy, of course, is a bear put spread. Now, we can use some good old-fashioned profit and loss diagrams to make some sense out of a bear put spread. And we know that, hey, if I buy a bear put spread instead of buying a put, I know that I'm risking less because the put spread is consequently less expensive than the put itself, because the put I'm selling offsets the cost of the put I'd be buying. I also know I limit my profit potential, but the P&L diagrams are really only valid at expiration. I want to know, hey, if that move comes early, if 3 days from now the stock falls, then how much am I going to make on my bear put spread? So what I can do is what I like to do is and what I tell my students to do is model their trades, kind of plug in a paper trade of the bear put spread into your trading account and then look at the Greeks and then sort of imagine scenarios. Well, let's see, what if the stock falls $3 in the next 3 weeks? How much do I make? Let's balance out delta versus theta. Okay, but what if the stock falls $3 in the next 2 days? How much do I make? Oh, okay, so it's this, I make more because I lose less on theta, and I make more based on delta. So now what that enables me to do is a couple really, really important things. One is it enables me to have realistic expectations. There's plenty of times where I see novice traders say, I don't know, I bought this put and the stock went down. I didn't make as much as I thought, or wow, I made a lot more than I thought. Well, that takes all that guesswork out of the equation. Now I know exactly what happens. If this size of a move happens in this amount of time, here's what I'm going to make or lose. And I can kind of fine tune and select the real most optimal strategy. I'm looking at one bear put spread, but I can look at maybe a different time horizon and see how the Greeks affect that based on my specific forecast. I can look at different strike prices and look at their Greeks, and I can maximize A, my probability of success, and B, my risk-reward ratio. So, it just makes you a better trader. I mean, imagine if on every single one of your trades, you could lose less and make more.
That'd be a good thing.
Yeah, it'd be great, right? And I'm not like, saying, hey, here's the holy grail, you're going to make money on every single trade you make. I mean, that's not realistic. But I'm saying when you use the Greeks in the manner that I'm discussing here, you can structure better trades in which you have the potential to lose less and the potential to make more, literally on every single trade. And you can I have some techniques for using delta where it can sort of indicate your probability of success. You can also potentially give yourself a slightly higher probability of success on each trade when you're selecting better strategies for the situations by using the Greeks. So, I mean, I think if you get just marginally better in your risk-reward ratio and your probability of success on every single trade, I mean, that adds up in your bottom line, at the end of the trading year.
Dan, I think that's just a fantastic note to finish on. Tell our listeners how they can reach you.
Sure. Once again, my name is Dan Passarelli, and you can visit markettaker.com. So that's market like stock market, taker like you take something, so 2 T's in a row, markettaker.com. And you can get a free ebook, markettaker.com/ebook, by surfing on over to our website.
Well, that's great, Dan. I mean, I think really some very insightful information for our listeners. We appreciate you joining us today on Strategy Spotlight, and we will be talking to you in the near future, I'm sure. Thanks so much.
Thanks, Joe. Thanks for having me.
It's time to meet the movers and shakers from the world of options. It's time for Profiles and Perspectives.
Joining us today on Profiles and Perspectives is Dave Whitmore, Senior Education Strategist at E-Trade. Welcome, Dave.
Well, thank you, Joe. I'm glad to be here.
Thanks for making time to talk to our listeners today. Before we get into E-Trade specifically, why don't you tell our listeners about your career path in this crazy options industry?
Sure, be happy to. I'm an old guy, so it's long.
That's a good thing.
I did my first option trade as a full-service broker for a national firm. No need to discuss who it was. Eventually, I had a small stable of accounts trading options back in those days. This was the days of paper order tickets. Later on, as the discount brokerage industry formed, I found myself in that area right at its core peak growth period. Early on, before the internet, even when that space first sort of took foothold, option trading was big then. The active traders who would be calling in their orders, brokers in that business had to handle a bunch of stuff and a lot of very complex stuff. Later on, I created a training program and trained our brokers for that firm. Option trading was a big part of that. In the sort of second part of my career, in the advent of online trading, I've been in the communications and product and education area, and I've been now speaking to investors and creating and delivering education for 15 years now. So
that's fantastic. Absolutely fantastic. And, why don't we just roll right into kind of what you're doing for E-Trade? How important are options when it comes to the business at E-Trade?
Well, I feel like I probably don't need to get too explicit and say it's big. Option trading is an increasingly important part of the arsenal for the individual investor and trader, and it's an important part of our business, as it is for the whole industry. I mean, the growth in the industry has been steady and substantial, and it's important for us, and it's growing for us as well. So, in a word, big.
Well, you're very kind to include OIC with one of your education or a number of your educational initiatives. How do you get education out to your E-Trade clients, and what kind of tools, option tools, do you offer them?
Sure. Yeah. So, you mentioned it, but thanks to you, you're right. OIC has partnered with us at our many of our live education events numerous times over the years, and that content has always been highly regarded by our audience. First, on the education front, one of the things I did is I went in and said, how much option stuff do we have in our online education center? And I counted 60 different pieces of content. Could be short form videos that go into one particular topic closely, could be longer treatments, could be written articles, could be stuff from OIC. A lot of stuff. As I said, across the sort of range of media. We also, a big part of our education is our live content. Like I mentioned, we do a monthly calendar of live workshops, some focusing just on our trading platform or the specific tools that we have. You asked about tools. We can certainly get into that in a moment. Or it could be educational topics. So it could be something like Introduction to Options or covered call writing, for example. And then we do a tour of in-person events, in-person live events, and these are some of the programs that OIC has partnered with us on. They're full-day events, ranging from trading topics to retirement investing topics, and options always play a really big and consistently big part in those programs.
That's dynamite. That's a really well-rounded program. Why don't we go back to some of the tools and the online, offerings that you have at E-Trade?
Sure. So to start with, option quarter entry, our chains give you displays for basic one-leg options, but as well as 2, 3, and 4-leg chains, as well as Greeks. If you have our E-Trade Pro platform, those chains are streaming in real time. Our order tickets have a live embedded quote in them as well, showing you the net. If it's a multi-leg position, those tickets allow you to enter 1, 2, 3, or 4-leg positions. And if you use one of our more advanced tools, you can enter orders or positions with even more legs than that. The ability to research things, you can use a pricing model, come up with theoreticals or implieds. There are numerous ways to display option material in our charts, both in E-Trade Pro and in our options research area of the website. If you're looking for ideas, we have one tool, our option screener, that looks for stocks whose options are exhibiting certain characteristics, maybe high implied volatility or high trading activity. That's one idea tool. The other sort of companion tool is what we call the strategy optimizer. And this is a tool that asks you to define your point of view on an underlying. Maybe I think Netflix, maybe I'm bullish on Netflix, for example, in a certain amount of time and an assumption of volatility. Strategy optimizer will give you option trades that would be favorable with that point of view. And then lastly, our option analyzer is the proverbial hockey stick chart or the option P&L chart that lets you live track multiple leg positions with a probability overlay so that the user can get a sense of the likelihood of the outcomes that they're plotting. So it's a big collection, and it runs the gamut from the basic stuff all the way up to the pretty sophisticated. So we're pretty proud of it, but we're always still working hard on it.
Well, that's fantastic. And I think, you mentioned the growth in options has been steady. And part of that, I think, has to do with, such a comprehensive suite of educational tools like you're offering there at E-Trade that certainly helps investors gain knowledge and build confidence to move forward.
Yeah, well, certainly, and that's always been a feedback element that we've heard from users and traders and customers about those elements, and that's why these tools bubble up, and hopefully we've got more up our sleeve.
Let me talk to you a little bit about your capacity as the senior education strategist.
Okay.
How do you go about helping investors at E-Trade develop different option strategies? How does that work?
Well, the way we try to create the content and deliver it is that, because of the fact that options have such a range of very specific language and functional complexity, sort of at first, the beginning really is an element of truly understanding all those elements and understanding that language and being at ease with that language. So our first step is to have a solid collection of the very basic stuff, the elements and the object and the definitions, and then a good solid look at the basic strategies. What is buying a call option all about? What is buying a put option all about? What is writing a covered call all about? And so once the mechanics of that are down, then what we really try to move the investor toward is now focusing on the very specific elements of the option trade, studying the underlying stock and having a point of view about where it's going probably means using charts to support your notion of where very specific option prices are, target prices on the underlying, to plot an option strategy around it. So I would just put it in, to sum up, in a two-part way. One, really focus on understanding the mechanics of the underlying, and I didn't even mention it, but it includes understanding the Greeks, and then applying that to analysis of the underlying and your sense of what that's doing.
So in your creation of strategies, are you then more focused typically on individual stocks or indexes? Do you take the broad market as a part of the perspective? Where do you go?
It seems like it's a perennial question, right? Is it a tough question? Let me give the middle of the road answer and say it's actually not so tough, because I don't think you can avoid or minimize either. Basic trading principle that the trend is your friend, and of course, in a very important sense, that means the trend of the overall market. The rising tide effect. But at the same time, with the very specific elements of an option trade, things like the strike, the time, the vol, the investor has to consider the elements of the stock very closely. I don't think you can avoid it. You got to do both.
It makes good sense. I mean, so many people get put off with options because they think they're so complicated. Do you think that's true?
Well, I think that goes back to my question about that you asked about how do we try to move the investor along in the process, and it's they can be complicated, especially in the early learning period, because of the moving parts in the language and getting all that down. And I mentioned it earlier about the Greeks, but you truly do have to, when you get beyond the notion of what's a put, what's a call, up, down, long, short, open, close, and you get all those concepts down, rights and obligations, then you start to go into the price movement elements of what the Greeks and pricing models show you, and the sensitivity to the certain factors, and then you can start to appreciate the range of what's available. So,
do you have a sense? I mean, and maybe it depends on the individual and their commitment to learning, but how long it takes for a novice to go from a novice, to an investor with some confidence in options?
It depends on how much of their own money's involved at the very beginning. You know what I mean? What I mean is you can do a lot of book learning, and I've certainly met lots of young folks, maybe right out of college, finance-type folks that know all the book learning about the options, experiencing the price movement with the underlying that truly treats you. So quickly, if you truly study hard while you're progressing, more slowly if all you want to do is learn the roots. But so, look, I would say that someone who is an experienced investor, stock investor, and has been in the markets for a long time, who spends several hours doing the studying to learn the language and that, can then start to get a good hang of things after a few months of trades. I guess it would depend on how many trades, but you got to look at that as a much longer road and not be too anxious to have great success right out of the gate, and learning to take some losses as part of that, But
also important to actually, get those trade, not just study, but to actually get that toe in the water.
Yeah, I hear you. Absolutely.
Okay. I guess maybe before we wrap, as you said yourself, you've been in this space a long time. Do you have favorite option strategies that are your go-tos?
I love them all, Joe.
Perfect. Well, thanks for joining us, Dave.
No, seriously, with the range on the menu, the investor/trader always has something at their disposal that they can use that can be profitably employed. Now, for what it's worth, if you were to look back at my trading history with options, a lot of it is based on the fact that I'm originally an equities guy. I'm a stock guy. I start off by thinking about stocks. So what you would find is covered call writing at times, long calls, long puts, some verticals. Not necessarily a lot. I don't like to cut off my upside. If you looked at those types of things that I did long purchases on, whether they were puts or calls, you'd find that it was based on a chart forecast for a price movement of the underlying stock. I typically held them for a few days, perhaps, maybe a couple weeks. Usually I buy them with at least a couple months of life, and I usually buy at the monies. So that would just be a basic rundown of how I have used options in my investing career.
Well, very good. Before we close, anything else to offer our listeners, either, your perspective or, things going on at E-Trade?
Well, I'll just offer them, I referenced these 60 pieces of of option educational material, and I would invite them to go to etrade.com, where all that information is available outside of our login. So you do not have to be a customer to get to that information. So if you want to go in there, there's a choice right up top for education, and you can navigate in there and avail yourself of the variety of option education material we have. So that'll be all, Joe. Thanks for the interview.
Certainly, Dave. Well, that's Dave Whitmore, Senior Education Strategist at E-Trade. Dave, thanks for joining us today, and I know we'll see you on the road soon.
Will do.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
In today's tools, resources, and good reads, we'll start with a website, www.optionprice.com. This is a no-nonsense site that offers an options calculator, a portfolio application where you can enter single or multi-leg option positions. There's also an implied volatility calculator and P&L simulators for 26 different option strategies. That's optionprice.com. Our resource today comes from our colleague Bill Ryan at OIC Investor Services. For those of you interested in margin requirements associated with different option positions, check out the margin manual at cboe.com. That's the margin manual at cboe.com. And finally, our good read today comes from our Strategy Spotlight guest, Dan Passarelli. Dan actually has written books, a number of them, 3 in fact, over the past 5 years. Trading Option Greeks, How Time, Volatility, and Other Pricing Factors Drive Profits is today's good read with this month's OIC educational theme of Greeks. Trading Option Greeks is in its 2nd edition. Dan's other 2 books are The Market Taker's Edge, Insider Strategies from the Options Trading Floor, and High Probability, Option Credit Spreads. I hope you enjoyed the Strategy Spotlight segment with Dan today. Do consider checking out his books. Thanks for joining us today on Tools, Resources, and Good Reads.
It's time for a nostalgia break. It's time to take a look back.
In today's Looking Back, we thought we'd take a look at the markets at various periods preceding recent presidential elections. If we start in 2000, the famous Hanging Chad election, in the 6 months preceding the November election, in Dow terms, the market moved around quite a bit, from about 10,800 down to in the neighborhood of 10,004, then up to almost 11,500 before swooping briefly below 10,000, almost down to 9,600 before settling in just before the election at around 10,600. So a lot of movement in those preceding 6 months. In the following 5 months after the election, the market settled considerably, trading at about a 500-point range between 10,400 and 10,900. Now, in the 2004 presidential cycle, the market was not as volatile as in 2000. In Dow terms, the June to October period had a very narrow range, only about 500 points. Ironically, a range very similar to levels in 2000, unfortunately. Starting in October of 2004, the market rallied from about 9,800 to just shy of 11,000 in December of that year, a meaningful 10% plus rally just after the election. We all remember the markets in 2008. Down, down, down. In the 5 months preceding the election, the Dow dropped from about 12,200 to about 8,000. Just nasty to the downside. And of course, the 5 months after the election, the markets actually, some would say crashed close to 6,500 in March of 2009 before the start of the great multi-year bull market. And our most recent presidential election cycle of 2012 saw some volatility prior to November, with the markets ranging from about 12,500 to close to 13,700, then pulling back again to about 12,500 before starting on another significant bull leg that took the Dow to about 15,500 by the summer of 2013. So that's the last few presidential election cycles. What all these numbers mean, well, I'm not quite sure, but market history is often worth spending a little time on. If I had to guess, my expectation for the markets between now and election time is a fairly narrow range into October or November, followed by a big move. Hopefully up, but we shall see. Thanks for listening to today's Looking Back.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of The Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.